Loan receivable is a financial asset arising from a loan granted by a bank or a financial institution to a borrower or client. Loan receivable is an asset. From that, we get the idea that in this topic, we will be preparing journal entries from the perspective of the entity which has the asset loan receivable. And that is the lender, the bank or the financial institution which extended the loan to a borrower. It will be helpful for you to keep that in mind as we go along. Just briefly, a financial asset is a non-physical asset whose value is derived from a contractual right or ownership claim, such as cash, bank deposits, mutual funds, bonds, and shares of stocks. Anyway, financial asset will be discussed more elaborately in another lecture series. In most instances, the term of the loan covers several years, and hence, the account name loan receivable, when there is no information with regards to the repayment period, is classified in the balance sheet or statement of financial position as a non-current asset. Nevertheless, it is possible to have a short-term or current loan receivable. Loan receivable is initially recognized at fair value plus transaction cost that are directly attributable to the acquisition of the financial asset. What is this fair value? This is normally the transaction price, that is, the amount of the loan granted. How about these transaction costs that are directly attributable to the acquisition of the financial asset? These include fees and commissions paid to agents, brokers, dealers, and advisors, levies by regulatory agencies and securities exchanges, transfer taxes and duties, as well as direct origination cost. The indirect origination costs are recorded as expense when incurred. More on origination cost or origination fees in a little while. Subsequent to the initial measurement, loan receivable is measured at amortized cost using the effective interest method. If both of the following conditions are met. Number one, the business model is to hold the financial asset in order to collect contractual cash flows on specified dates. This business model is in contrast with the two other models for managing financial assets, which you will learn in another lecture series titled Financial Assets at Fair Value. And number two, the contractual cash flows are solely payments of principal and interest on the principal amount outstanding. This is according to IFRS and PFRS number 9. You will know what amortized cost is when we prepare an amortization table later in the series. Going back to origination fees, normally, prior to the actual lending or disbursement of funds to the borrower, certain activities must be performed in order to identify and attract potential borrowers and to originate a loan. Those fees which are charged by the lender against the borrower for the creation of the loan are called origination fees, which include compensation for activities such as evaluating borrower's financial condition, evaluating guarantees, collateral, and other security. Because remember that in most cases, a lender requires collateral or security before granting a loan, the cost it charges the borrower for the evaluation of the collateral is an origination fee. Likewise, the fees charged for negotiating the terms of the loan, preparing and processing documents, and closing and approving loan transactions are origination fees. Origination fees received from a borrower are recorded by the lender as unearned interest income, initially deducted from the carrying amount of the loan receivable, and subsequently amortized over the term of the loan using the effective interest method. However, there are origination fees which are not charged by the lender against the borrower, meaning not paid for by the borrower, but are instead shouldered by the lender. Those origination fees are known as direct origination cost. From the viewpoint of the lender, they are indeed better called cost rather than fees. Because again, they are not charged against the borrower. They are not collected from the borrower, but are instead shouldered by the lender. In contrast, those chargeable against the borrower are better called fees from the lender's perspective. That's my personal take actually, because the terms fees and cost are sometimes interchangeably used. As you can see here, direct origination costs are also considered origination fees. Anyway, direct origination costs are deferred and amortized over the term of the loan, and preferably offset directly against any unearned origination fees received from the borrower. Offset directly against any unearned origination fees received from the borrower, meaning the origination fees received from the borrower and the direct origination cost incurred by the lender are preferably deducted from each other. If the origination fees received from the borrower exceed the direct origination cost, the difference is credited to unearned interest income, and the amortization will increase interest income. However, if it's the other way around, that is, if the direct origination cost exceed the origination fees received, the difference is charged or debited by the lender to direct origination cost, and the amortization will decrease interest income. Consequently, the origination fees received and the direct origination cost are included in the measurement of loan receivable.